Welcome, Andy Salembier at Accolade Partners, to this INBrief for the Inside Network.
Good to see you, Laurence. Thank you so much for the time.
Delighted to host you again. Look, we were so happy with the experience over in Queenstown at the Investment Leaders Forum. So much rich content, but ultimately as well, an opportunity for you to come across and spend so much quality time with investment leaders from the advice community in Australia and New Zealand. What were your key learnings from their dilemmas, their challenges, and the work that they're doing?
Yeah, it was a really interesting conference for me. As a partner at a US-based private equity fund of funds manager, my view on the world is much more narrow than I think the broader investment landscape. And also, it's much more narrow than the broad group of individuals that were at the conference. And I thought it was really interesting to learn about how New Zealand and Australian entities think about and dig in and construct a broad and diversified portfolio. As we talked about, we have a number of limited partners in that region, but there's only so far you can go to understand how they think about portfolio construction. So to me, I think the thing I took most out of the conference was getting a better understanding of how various groups within the New Zealand, Australia, and broader region think about building portfolios. There's also some more distinct niche strategies that I thought was really interesting. There was a interesting segment on power generation. There was a segment that really dove into Japan. There was a segment that talked about growth investing within the region, which is a little different than the growth investing we do. But those were more niche segments that I found really interesting.
Let's talk about your niche. How has that evolved over the past few years, particularly a decade of considerable change in capital markets?
Yeah, so it's funny. One of the things that's evolved a lot is the definition of growth equity. I think has been really taken over by later stage venture managers as they call their later stage expansion stage product growth equity product. And to us, growth equity is really about finding modest sized, bootstrapped, profitable businesses that need one round of financing to help grow that business to some type of exit. And that exit is typically an M&A type of event. So that is one thing that has evolved, is just kind of the definition of growth equity. I think also in that space, firms have moved up market, and this has been a constant trend that we've seen over the last few years and really over the last 20 years when we started allocating to this space. Managers will start out a little bit smaller, doing smaller deals at smaller fund sizes. And over the course of 4 or 5 fund cycles, you see the target companies that they're looking at go up significantly in size, and you see their fund sizes moving up in size. So that's one of the things that I've definitely seen evolved over the years. Also, capital in the space, I think, has been pretty consistent, and definitely over the last few years, there's more institutional LPs looking for newer groups that have an expertise in this area, and that are unique with a good track record, and capital is readily available there because people are very much targeting this space. Other things have been more consistent. I would say M&A has been consistent, and the type of M&A transactions have been pretty consistent across both financial buyers and strategics.
You reference venture capital. That's obviously something that a lot of advisors think about and might be discussing with clients. Where do you see the key differences in your world in growth equity?
Yeah, so to me, the key difference here is the type of business and what the ultimate outcome is going to be. Liquidity, there's often a disconnect on liquidity and the scale of a business over time. Venture often is going for larger outlier type of returns. That often results in the need to raise multiple rounds of capital, which also results in returns being much more hits driven. I would say in private equity, growth equity, which is what we're talking about, I think there is more alignment with management. It's only one round of capital. It is less hits driven, and we've seen very consistent returns. The loss rates tend to be very modest, given that these are profitable businesses that are growing nicely. So those are kind of the core differences that we see between venture. Similar sector exposure, definitely different return characteristics.
And at Accolade, you've referred to some of the key traits, but what characteristics are the most salient you're looking for in a potential business?
Yeah, so in this private equity growth space, our managers are looking for companies that are profitable or could be profitable with a small adjustment in operations. They've typically not raised outside capital, so they've typically been bootstrapped. Sometimes friends and family will have a small round of financing. They typically also do not need future capital. So when they're thinking about the business model, this is really the one round of financing that they're going to raise, and it's going to allow them to either improve their operations or target a new vertical or maybe acquire a customer, but they're not looking to raise round after round of capital. They tend to have strong recurring revenue. So these are lots of software businesses. The margins tend to be high. The customer base tends to be very sticky and very diverse. So like I said, often what we see is either vertical market or horizontal specialty market software businesses that are in this space.
And what about the health of the IPO architecture and pipeline? Does that have any bearing on some of the exits that you're looking to achieve?
Yeah, it's a great question. The IPO market, as you know, has been quite stagnant for a while, at least in the US. And it does not have as much of a bearing on the growth equity space, or really does not have much at all of a bearing on the growth equity space. We see across the 20 years that we've done this and the 350 exits, we've seen about 95% of those exits come through M&A, and M&A has definitely expanded in terms of who's doing that M&A. So you have your classic strategic that's looking to incorporate some type of technology into their more traditional business. And then you also have the financial buyer, and that really takes two flavors. You'll see the big buyout firm just buy a company, or you also see a private equity backed company who will make the acquisition to do an add-on acquisition for that business. So like I said, the M&A market has clearly evolved in that space. Which has been great, and it has not needed the IPO market. The IPO market in the venture world was quite healthy a few years ago, and has been quite quiet the last 24 to 18 months. So it's in the growth equity space. It's nice to not necessarily have to have that IPO market to drive exits.
And so, Andy, we had a marvelous atmosphere, experience, collegiate thinking. Now those advisors are back leading their practices and working with clients. We can chime in again and offer them some insights. What would you like their single one key takeaway to be from the contribution that you were able to make to the conversation?
Yeah, we really believe that growth equity offers similar sector exposure as venture, similar to returns as venture, but with a risk profile much more similar to private equity. And I would think that it would be a great addition to many people's portfolio as a diversifier, to add private equity as part of their portfolio.
Well, we were so glad to have you join us, and we hope very much that in the months, years, and decades to come, we'll host you again. And so thank you so much to Andy Salembier.
Thank you so much. It was a wonderful event, and really appreciate the time and having the ability to present.